We're going to do our best to unpack what the panel on the other side of the room has given us today. And we're very mindful, actually, of a bunch of the issues that they raised. The issue of, do we talk about performance first? Do we talk about impact? How do we find the balance between those two things? How do we think about the challenges that Paul raised with respect to sell side, maybe doing a better job? I think what we have here on this side of the room is a group of individuals who are doing all very, very different things, who represent different types of investors, different investment vehicles, different risk profiles, different time horizons, performance expectations, and even impact expectations. And we're going to try and cover a bunch of ground, and we're going to do it pretty quickly, as it turns out. So, joining me are Sarah Carney, founder and executive director of Prime Coalition, out in the very middle of the room. Next to Sarah is Joyce Ferris, who is CFO of Spring Lane Capital. Moving this way, Jennifer Von Bismarck, managing director of Arena Investments. Next to Jennifer is Zach Knight, who is a co-founder and managing partner of Blue Forest Conservation. And immediately to my right is Asha Mehta, who is SVP and portfolio manager at Acadian Asset Management. And my name is Bill Davis. I am founder and portfolio manager of Stance Capital. So I'm going to start with Sarah, and I'm really glad you showed up because I was wondering actually where you were.
I've been here. I wanted to see their faces while they were talking.
Oh.
Happy to be here.
So my question is that given you work exclusively with philanthropic organizations, and given that your mandate is very much directed around impact, how does the impact mandate reconcile itself within the diligence and screening and investment process? And then also, how does Prime actually think about impact in general?
Do you want me to use the glasses down?
Yeah, I think we need to.
Hi, everyone. So Prime has three specific criteria that guide our investment decision making, and I will tell you exactly what they are. But before I do that, I want to take you back on a journey that I went on back in 2012. I went on a listening tour and talked to hundreds of different types of philanthropists, large institutional foundations, small living donors with few staff, donor-advised fund sponsors and clients, individual and household donors, and made a list of all the reasons that the type of investing that Prime now does is very, very difficult to do without an intermediary. And so as I tell you about our investment criteria, I want you to imagine trying to assess these things as a single actor and realize that each of the three criteria is an enormous bucket, kind of body of work that is very difficult to evaluate. And so that's what led us to form Prime in the first place, are these investment criteria and how difficult they are for any one party to assess on their own. We had the luxury of starting from a blank sheet of paper, and the three investment criteria that we came up with are climate mitigation potential, which I can go into in more detail in a moment, attractiveness to follow-on commercial investors, and fitness for charitable capital. So that's really getting down to additionality, and would this company have a difficult time raising capital without our intervention? And so for that first bucket, climate impact, in our case, we're focused on early stage innovation. What's very difficult for anyone, no matter how many resources you have to do in that bucket, is that we're assessing companies that are not yet deploying product in the field. And there's lots of climate impact measurement tools that are great for later stage companies that have proven solutions, that are deploying in the field and trying to assess what their current and previous climate impact is, but to forecast forward with huge error bars is an incredibly difficult thing to do, even if you had all the data sets that you needed to make those types of predictions. So that's a whole body of work that we've now partnered with the New York State Energy Research and Development Authority to codify how we do it. We are building a software tool that we're going to make open source in hopes that many, many more early stage investors will have easier access to that very labor intensive exercise of incorporating emissions reduction potential into their investment decisions. So if you're interested in that tool, we want to make it useful to as many people as possible. Come and find me. So that's climate impact. The second, attractiveness to follow-on commercial investors and fitness for charitable capital. We have an external volunteer investment advisory committee. It's made up of 12 of the most active and historically successful traditional venture capitalists in the space. We ask them to say, yes, I would love to invest in this company if it reaches a certain milestone, and also enumerate the reasons they would not be able to convince their partners to do that deal today. And so that committee is critical to those second two criteria for us. And from the registry of every early stage energy, agriculture, waste, and water company in the US that we look at, last year it was 2,400, we whittle that down to 5 or 6 annually. That up until now, we've syndicated on a deal by deal basis. We have 10 in our portfolio. We've worked with just over 50 philanthropic organizations to do that. Each one of those companies promises at least 1 gigaton of CO2 equivalent emissions reductions annually if it were to achieve commercial scale. So very, very high impact. And in terms of tracking and reporting, because I think that was part of your question, Bill, we do 3 things. We report company operating milestones and progress on a twice a year basis. We do general social impact reporting about the whole portfolio annually. And then we've promised a deep dive climate impact assessment of all of the supply chains of all of our portfolio every 5 years. So the first one of those is going to be due in 2020. And that'll be about both the 10 company portfolio we've done on a deal by deal basis and the beginning of the portfolio that will be coming out of the Prime Impact Fund, which conducted its first close on Friday.
Congratulations. All right, so now I'm going to bounce over to Zach. And Zach, you have an equally interesting business model. And I have to say that I had never heard of a forest resiliency bond before getting ready for this panel. So can you tell us about the bonds, tell us about the ecosystem that you operate in and what you're trying to accomplish?
Yeah, absolutely. I feel like with this part of the discussion, we're going to go from up here down to one specific issue and one solution here. So again, my name is Zach Knight. I'm managing partner of Blue Forest Conservation. And we're actually a benefit company that's been entirely grant funded by groups like the Rockefeller Foundation or the Moore Foundation, but also Department of Agriculture and the EPA. And our model is really looking at how can we use financial innovation to create sustainable solutions to our most pressing environmental challenges. In our first project, the Forest Resilience Bond, we've partnered with the U.S. Forest Service and the World Resources Institute to create a private financing mechanism that can actually reduce the risk of catastrophic wildfire. I think it's important to take a step back and get a better understanding of the issue and what we're actually trying to solve. And when you look at forests in the western U.S., we have excluded fire for the past 100 years. And right now our forests have about 10 times as many trees per acre as would be naturally occurring. And when you combine that overgrowth with an increasingly hotter and drier climate, you get years like 2017, which was the worst wildfire season in recorded history. 2018 is not far behind it at all. And actually, at the end of the day, when you think about it, the Sonoma fires that we had in California last year and the Thomas fire down in Southern California, those were just happening at this part of the year. So we're way ahead of that in 2018 to really get an understanding of how bad this is. And when these fires start, and I'm saying when, not if, there's a tremendous amount of other impacts. It's not just releasing carbon, it's not just destroying habitat. But in California, you know, we get 65% of our developed water supply from snowpack in the Sierra Nevada. When you have a fire come through some of those areas, these are not productive, reliable systems for utility managers that have to provide power. They have to provide water. You see folks displaced in rural communities, and that community resilience and creating rural jobs is a huge goal for the state government of California. So when we look at this, you say, okay, well, there's a really big problem. What do we do about it? The good news is we understand the solution. The Forest Service has been doing forest restoration for 30 or 40 years now. We're just not doing enough of this work. And so when you take a step back and you think about that, it's not a science problem, it's actually a finance problem. And that gives me quite a bit of hope. One of the reasons why we're not able to do this work at the pace and scale that we'd like to is if you went back 20 years ago, you know, Forest Service spent about 15 or 16% of their budget fighting fire. Last year, they spent $2.7 billion, or 56% of their budget. And in just 3 years, they expect that to be 67% of the budget. So what you're looking at is this vicious cycle where we're spending money today to put out fires that was designed to prevent those fires in the first place. So it really is a financing question that you're trying to solve here. At the end of the day, the backlog of work the Forest Service needs to do is about $100 billion. And if they continued at their current pace, they would finish this work in about 200 to 250 years. And this is the only thing that's keeping all of our forests from burning up here. So yeah, just want to stress that part. So what we've done with the Forest Resilience Bond is this is really an environmental impact bond. It's a public-private partnership that allows private capital to come in and cover those massive upfront costs of doing these restoration activities, and then allows all of the beneficiaries of this work, so the U.S. Forest Service, but also those water and electric utilities, a flood control district, a state agency, a private bottling company or beer company, even railroad companies, to really pay for the benefits that they receive from these projects. And when you combine all of those cash flows from the different stakeholders, you cover the cost of the project plus a modest return for investors. So this is one of the things you'll see, and we can talk more about this as the panel moves on, where we understood a problem and have created this investment as a solution to that problem. And it's worth doing in this case because it is an incredibly large problem. So all of that brain damage to get the Forest Service on board for this first project is worth it because they will be the anchor tenant in the next $10 to $100 billion of financing in this space.
Great. Jennifer, ARENA makes loans to small businesses in the clean energy space. What problem what space in the market are you filling, and what problem are you trying to solve? And also, who are your investors and what are their expectations?
Sure. So just by way of background, I'm Jennifer von Bismarck, and I'm one of the founding partners of ARENA Investments. And we have a couple of different pools of capital that we are deploying, one in clean energy, loans to clean energy small businesses, and one that focuses on commercial property assessed clean energy. And we are really a credit fund. So this is much later stage, lower risk type of investments. And I'm listening to what everybody's talking about. And for us to be able to put capital out the door, we obviously have to invest in companies who are doing something that has a lower risk component to them. And so we tend to be asset based. And when you think about the tremendous amount of capital that needs to come into this space to actually create the impact globally that we're looking for, what we need to see is more businesses deploying technologies. They need to reach a stage, they need to get out of the early stage and into the deployment of their assets. Their technology needs to be proven, and then they need to start putting that to work so that we can then lend them capital backed by those assets to help accelerate the speed of deployment. And so what we obviously enjoy the growth of the clean energy industry in the U.S., but there's a basic model, which is the power purchase agreement, which is now being used to fund lighting as a service and water as a service and all sorts of other things that we need to see as a service. And that is a very useful tool for us. And so what we need to see is more companies coming through and using those methods to deploy these systems. But we also need to see more institutions willing to invest in this asset class and say, I haven't seen this before, but I understand it. Because again, what we see from our vantage point is, we're credit folks and we're doing our credit work, and these contracts make sense and you have to read them and understand them. There is brain damage involved. But it's not that hard, and it really has a massive impact, because if we're going to deploy the capital, what the capital needs to be doing is implementing solutions. That's what the whole couple $1 trillion is about. And the way those solutions get implemented in the best way is through private companies who have that local footprint, who are distributing the technologies. So when I think about the institutional investor community, and if they're thinking, what can we do to put capital to work, I would love to see institutional investors say, I like to invest $50 to $100 million at least per fund. Think about impact as a single fund, and put $100 million aside per year to invest in impact, and allow that to be allocated to a bunch of different strategies, $10 million per strategy, because they're going to need to start out smaller. They're not going to give you the data that you need to have to say this is proven, and it's just like the other things I've done. But there are tons of professionals who can show you how to do the work and get through the credit analysis to show you that you can make an attractive financial return putting this capital to work. I think whether it's on the early stage company, we're seeing tremendous growth in solar companies and water recycling technologies. There's tons of capital to be made. And if you will look at this sector as, just as you were saying, as the future and the growth and where the new infrastructure is coming from, I think you'll start to see more businesses, so we'll have more people to lend to, and you'll start to see more investment products because deal teams will get specialized in these asset classes and these geographies. And we need to, it's sort of a chicken and an egg, but I think we all are responsible for doing what we can to break that cycle and start putting the capital out there.
Yeah, I'm sort of reminded of a conversation I think we all had on the phone last week, where we were talking about the fact that it wasn't all that long ago that wind and solar were considered sort of the Wild West, right, of investing, and now it's so commoditized that, it's barely even considered, I think, impact from an investment standpoint. It's just...
And the role of the institutional investor, one of the things that happened in residential solar installations is one impact investor said, you know what, I get this and I like this. I'd like to see more people have solar on the rooftop. Banks aren't lending against this yet, so we're going to lend. And we're going to lend to the development company to start putting solar panels on everybody's rooftop. And that loan is backed by loans to the homeowner. But that's a good asset. I mean, we have, small business homeowner lending in other asset classes, and it's not that different just because it's for a solar panel. So an impact investor was willing to raise their hand and say, I'll do that homework, I'll make the credit available, and that company was able to grow and become one of the larger resi rooftop installers, and now it's like a boring asset class, and S&P does quarterly updates on their methodologies. And it didn't take that long. It just took somebody willing to say, I understand that, I'll do that.
Right. So one of the things that I think you're hearing so far is everybody does something very, very specific and for a reason. And Joyce, you're actually doing something very specific, which I never really thought about before, but this idea of highly distributed assets. Can you talk about what Spring Lane is up to? And
yeah, I'm with Spring Lane Capital. We are a first-time fund we are currently investing we're essentially taking institutional capital, managing it in a private fund to invest in sustainable infrastructure assets. So, and we also are putting some capital into the technology providers or developers. So the example of solar is a perfect one. We don't do solar, but we'll invest in all sorts of energy projects, on-site energy generation, storage, efficiency. We do waste-related projects, solid waste, wastewater treatment, agriculture, food-related projects, and we work with technologies that are past the beta stage, that are mature technologies that have been proven in at least a couple installations, and they're now at a stage where they need a sophisticated type of capital that's not venture, because venture isn't the right tool for the job. It's not yet low-cost debt, which is what's really fueling the solar industry, but they're on a path to that. And they need a steady stream of that capital that they can rely on, because they need to shift their business model and their sales process to sell their skid-mounted on-site wastewater treatment facility as a service rather than an equipment sale. So it's, I think a lot of what one of the themes I hear is it's really filling the gaps in the ecosystem. And there's all sorts of flavors of capital that are appropriate at different stages of a company and a technology maturity. And as capital is starting to go to the sector, there's opportunities for different risk profiles, different risk-adjusted returns. But as the the portfolio of available capital and the flavors matures and expands, I think you are going to see a lot more scale. And we're sitting in a very important middle spot where you can only get so far in building a distributed sustainable project with VC capital, and you're not yet at a point where the big debt, lower cost debt capital, which is now flooding into wind and solar, but we're that bridge to it. And there's an amazing amount of opportunity to do it.
Okay, now we're going to switch gears, and Asha and I are the two people on the panel focused actually on public equities. And it's a bit of a different space because there is some, well, first of all, and somebody said this on an earlier panel today, not everybody has the means to invest in private investment vehicles for a variety of obvious reasons. Almost everybody at one level or another has the means to invest in public vehicles if through no other channel than their 403B or their 401K. But the point is that there is both risk reward associated with understanding the impact of climate risk on public equities, and there is impact. And both of these things are sort of hiding in plain sight in some ways. And so, Asha, and Asha and I have some things in common. We're both from Boston. We both live in the same hometown. We're both quantitative portfolio managers. And between us, we manage over 95 billion in assets, although pretty much, I'm an emerging manager. Pretty much all of those assets are Asha's. So, but Asha, how do you, given your role at Acadian, how do you think about climate risk impacting equity portfolios, and what solutions specifically is Acadian offering?
Yeah. Thanks, Bill. I'm thrilled to be here today. What a fascinating discussion, and definitely echo Bill's comments that this is really the other side of the spectrum, representing more of the boring asset classes where we do have quarterly updates from the securities we're invested in. So Acadian is a relatively large institutional manager relative to emerging managers. We manage just under $100 billion in assets from the quantitative perspective. And many of our clients are coming to us, prospects as well, looking for environmental solutions, asking about, how is, Bill's question, how is environmental risk impacting our investments? Because we're a public equity investor, a meaningful difference in terms of how we invest relative to other strategies is the holding period. Typically, a holding period for our securities is on the order of 1 to 2 years. So some of the challenges or opportunities we're looking at are just meaningfully different relative to more private investments or even fixed income related investments. I do think across the space, ES&G, the environmental side is among the fastest growing, at least in terms of interest, in terms of the type of diligence we're being asked for. Might be related to the US pulling out of the Paris Agreement. That sort of seemed to be a turning point from where I sit at Acadian in terms of meaningful interest coming in. Today, the US is in fact the only country that hasn't signed on to the Paris Agreement. Back when Trump pulled out, we were one of 3 countries who hadn't signed on, alongside Syria, who had sort of their own stuff going on. They went ahead and signed, and Nicaragua, who actually hadn't signed because it wasn't binding enough. And they decided they didn't want to be with the US in terms of being the naysayers. But to that end, we do see tremendous interest today globally. In the US, that interest is growing. Ex-US, it's very, very active. The way we think about environmental risk impacting our portfolios is in a couple different ways. One is sort of the physical risk, this idea around stranded asset risk. At what point do the assets we're invested in or the assets of the companies we're invested in essentially become underwater? They're effectively stranded. Again, I mentioned the holding period dilemma we have. We're invested in securities for a much shorter period of time than is likely for stranded asset risk to impact the valuation of the companies we're invested in. It's not completely true, but it's mostly true. I think of coal companies, for example, that as their business models have become less economical, those investments have to some extent become stranded in a sense. Trump's doing what he can to sort of revive them. The way that we most directly see environmental risk impacting our investments is more through carbon pricing. Bring back one of those earlier comments. Carbon pricing, of course, is not there is no consistent model for it. There is no global carbon price. Definitely, if we had one, it would make investing along this theme much simpler. Many of the companies I talk to, many of the integrated companies, the super majors, are calling for a carbon tax because it makes it easier to plan around. Given that we don't have a global fixed carbon price today, the way we think about environmental risk and pricing that carbon risk in our models is in a very dynamic way. So we look at implicit carbon risk impacting our portfolios. We do it on a regional basis. In Europe, there is a carbon pricing mechanism. In parts of the US, there is as well. So we're looking granular at implied carbon pricing mechanisms and essentially taxing the valuations of companies we're invested in. So if we believe a company is exposed to significant carbon emissions, or they're likely to have significant carbon emissions in the future, we will tax the valuation associated with that company so that we're less inclined to invest in that company. We don't do that for our ESG clients. We don't do it for clients who come to us with an impact focus. We do it because it makes sense from a returns perspective. We're looking for good investments, and therefore all of our investments incorporate this carbon tax. All of our clients are essentially invested in an environmentally sensitive way. Again, we're doing this because it makes sense from a fiduciary perspective, not simply because there's an impact rationale, which we could come back to.
Do you have clients who don't care about that and you just simply don't talk about it?
Yeah. So for the majority of our US-based clients, I'd say, again, that interest is growing. Mm-hmm. But today, it's not necessarily significant demand across the full asset base. Again, those clients would have exposure to this anyways. I actually had a Dutch client who came to me and said they weren't interested in this, and I was sort of blown away because in Europe the demand is so high. But again, because it makes sense from an investment perspective, and first or foremost, our objective is to maintain our fiduciary duty of maximizing risk-adjusted returns. It's in there. A couple other solutions we offer. This is sort of the one I think is the most dynamic and interesting and impactful. We do have low carbon strategies, and this is an area where we've seen a lot of interest more recently. The other sort of big problem, Leah mentioned this in her comments around this space, is that to a large extent, carbon risk cannot be back-tested. This is a future risk. So as a quantitative manager, we are dependent on the back test. We need significant data, which is another problem. We need to be able to see that implementing data in our framework will in fact improve returns. In the context of a low carbon portfolio, what we find is that we can decrease the carbon footprint of our portfolios at essentially no cost. So we can tilt a portfolio toward a lower carbon profile because we're quant managers, where we have tens of thousands of securities we can invest in. We can readily substitute a high carbon emitting, very attractive security for a low carbon emitting attractive security. So we can make those trade-offs. We've seen a lot of interest there. Going way down the spectrum in terms of level of interest and where we see sort of more niche type interest, we've worked closely with Cambridge Associates on this. We've developed fossil fuel-free strategies as well. And in that context, again, we're able to substitute a fossil fuel firm with an attractive alpha profile for a firm that isn't in one of those extractive industries with a attractive alpha profile. So across the spectrum, there are a number of opportunities. I'll pause here, Bill.
Okay.
I've got a lot more questions to ask.
You can hold on to that for a second. Yeah, so from my perspective, we, as a much smaller firm, much smaller firm, we focus on one product, which happens to be an S&P 500 universe product. I tend to think of climate risk as a form of portfolio risk, and to that extent, it's worth mitigating. But as a quant manager, we're a little like you. We might only hold a position for a year, maybe two at the most. So unlike SRI managers, we're not getting into a company and trying to work with them for the next 10 years to make them better and realize the upside. We're interested in finding companies who are successfully mitigating these risks. So the chances are these risks are never going to materialize in a year. And so it's a free option, is how I think about it. And I also think that in the public equity space, there's a second free option, which is that it's the opportunity to align your capital intentionally with your values. And those values could be environmentally driven. They could be based on faith or gender or resiliency or really anything you want them to be. But it's a free option because all of this stuff costs nothing. And that actually, I'm going to pivot, and before I bounce it back to the group, I think one of the challenges, and I'm going to pivot to this idea of impact generally, but one of the challenges in the public equity space is it's really, it's really easy to see the impact that Zach and Jennifer and the rest of the team, Sarah and Joyce, are creating. But with you and I, it's a little bit trickier because, what are you really doing? You already own the public equities anyway. And from my perspective, what we've tried to do is really kind of put it in plain English, which is to say that let's say you're concerned about climate risk, you're concerned about the impact on your kids and your grandkids and future generations, and you own passive index funds. You own them in your 401ks or 403bs or your taxable accounts. And so let's just say you've got a family that owns $500,000 in an S&P large cap index fund. Essentially what they own is the entire S&P, or more correctly, what they own is a pro rata share of the entire S&P. And we can actually quantify easily what the market cap of the S&P is. It's actually like $25 trillion. When I actually did this calculation, it was the beginning of the year and it was 21 trillion, or maybe it was late last year. So you can actually calculate your percentage of the ownership of that index. We can also calculate, it turns out, the scope 1 and 2 carbon emissions for the entire S&P 500. For anybody that's interested, it happens to be 4,300 million tons per year. So you can take your percentage of ownership, I say you, but let's pretend you're the $500,000 investor, and you can now calculate your percentage of the carbon of the S&P 500, and you can determine whether or not that's an acceptable number. Now, it turns out that $500,000 is roughly equivalent to about 125 metric tons of carbon a year. That's what you own just in your large cap index fund. You also maybe have other holdings that create more carbon. You also have a life, right? And in your life, you fly on airplanes and you buy things and you eat food and do all this other stuff. Well, the average family of 3 in the United States has about 50 metric tons of carbon that they are responsible for per year. So one way to put this in perspective is that your large cap holdings alone are 3 times the average family in the United States from a carbon perspective. So if you do care about impact, a really easy, obvious, hiding in plain sight right in the middle of the room place to start thinking about that impact is decarbonizing. Again, we're talking about carbon specifically here. We could talk about something else, but decarbonizing your investment holdings. And as it turns out, there are plenty of, not enough as Paul would say, maybe we need more, but there's a growing number of managers who are generating the same level of returns as the underlying benchmark net of fees, and they're doing it with low carbon or no carbon or lower carbon. And it's just a simple, obvious way to think about it. So that was longer than I intended to take, but how do you, at Acadian, how are you being asked about the impact that you're creating, and how are you moving forward with that?
Yeah, no, that's great. I echo a lot of your comments, and I agree that measuring these themes is really such an important place to start, sort of the classic, you can't manage it if you don't measure it. That's somewhat obvious, but actually very, very hard to do. And I alluded to this earlier when I mentioned that data is a real problem in this space. Again, it's a forward-looking theme, not a backward-looking theme. We don't have years and years of history across a broad cross-section of companies that have provided information on their environmental footprint. So carbon emissions is one very, very tangible aspect of it. When you run those reports, that's helpful. It provides a snapshot. It's a way for an investor, one of our clients, to look at the exposures they have. So how much are you contributing to the overall carbon emissions in your portfolios? So that type of just basic reporting is one thing we do. That in and of itself, believe it or not, is somewhat innovative. I think in sort of this institutional market, ESG reporting and impact reporting is somewhat new. Clearly, it's taken off given the amount of interest, but it's still somewhat in its nascency. The other aspect is around, actually having a direct impact, not just measuring it, but doing something about it. And this is part of what I think makes this space so fascinating. There was a comment earlier around how this space has evolved from SRI to ESG. Certainly echo that. As institutional managers, there was once upon a time, and investing in a way that is consistent with your morals and restricting capital to certain types of businesses. Then we move toward ESG, where you're looking at business practices, our companies implementing best practices. But I have no doubt that where this goes over time is that all managers will be asked to show that we're not just benefiting from the companies we're invested in, but that we're actually having an impact on the companies we're investing in. That's a real challenge. As a quantitative manager, we have thousands of holdings. We hold these companies for 1 to 2 years. We can't engage with every company. And they may not take our calls knowing that we may very well sell out of their security within a year or two anyway. So it is a real challenge. It's a real problem. It's a real opportunity. What we seek to do at Acadian to address this is to really focus on the authenticity piece. How can we engage in a way that will impact our process in a positive way and impact sort of the broader community? The take we have today is to focus on that central challenge, which I mentioned before, is data. We just don't have a lot of data. What we can do to promote better data availability is better for the community and better for us in terms of our investments. Bill, I know we've talked before about collaborative engagements as one way that you can really have an impact at relatively low cost. The PRI is one organization that hosts collaborative engagements. Climate Action is another one, and where we can combine efforts with other investors and call on companies to produce this data in a more standardized and transparent way. We're having an impact, and that improves our investments.
Great. Joyce, what about you? What are the impact expectations, and are they evolving?
Well, the beauty of being in the sustainability sector is all of our impact, it's environmental impact. There's a resilience impact too, especially with distributed on-site infrastructure. It's all quite measurable. I think that, and it's totally aligned with the financial performance of the assets. So I always say, relative to some of the other ESG kind of measuring, environmental stuff is very quantifiable. It's an engineering problem, really, or we're solving something that's either measured in kilowatt hours saved or wastewater reduction, or it's fairly straightforward. So what we're doing is really fueling the scaling of these more efficient solutions that are having a positive environmental impact.
Okay. Sarah, you and I talked a bit about the valley of death that early stage companies exist in, and many of them never leave. How do you think about that, and how big is that addressable market, and where does Prime stand on all that?
Sure. So I think a lot of people talk about the valley of death. I think there's many. I think getting back to this conversation, there are friction points all along the innovation and deployment process where new, creative, talented teams of people need to form around if we're going to fill those gaps and crowd in traditional commercial capital. The gap that we focus on at Prime is the earliest stages of company formation, where companies are dying on the vine as they transition from basic science to commercial readiness. We know there are thousands of good ideas bubbling out of university labs and national labs. Every year, my team at Prime compiles a registry of every early stage business in the US, from pre-seed to Series B, across energy, agriculture, waste, and water, because we're industry agnostic. Our end goal is climate change mitigation. Last year, that list had 2,363 companies on it. And so we know there's no shortage of good ideas, but we also know there's a serious shortage of capital willing to go first. Thomson Reuters and PricewaterhouseCoopers in 2016, Q2, Q3, and Q4 reported $0 of initial investment into anything flagged as clean tech. And then after 2016, they stopped collecting data on the clean tech flag. Now, we know they missed things from parties that are not compelled to share their data, like family offices, but $0 is a very scary goose egg in the same moment that everyone was sitting in Paris. So our hypothesis at Prime is that philanthropists are well positioned to help fill this gap. By definition, we have multi-generational timelines. Social causes like climate change mitigation are our paramount end goal. And although not many people are doing it yet, we do have mechanisms to place money that would otherwise be made as grants into for-profit companies and projects, using traditional grants through an intermediary, recoverable grants, program-related investments, or just concessionary mission investments. Philanthropic capital in the US alone is an enormous opportunity. If we could unlock even 1% of annual grant making, it would eclipse the entire venture capital industry, whether early or late stage, across all industries. So it's really, yes, it is a skinny tree in the context of all global assets, but this money is special. It can do things that nobody else can do because the opportunity cost is a negative 100% return. And so just to give you one very concrete example that I think speaks to your question about capital gap, our very first investment it was an idea from a Saudi Aramco engineer, a geophysicist. He did all the computational modeling around using spent oil and gas wells to do pumped hydro downhole. Pumped hydro is the most ubiquitous form of grid capacity storage on the grid in the US. You just can't do it everywhere you need to dispatch electricity. You have to pump water up a hill, you need to lop off the top of a mountain, let it pour back down and turn a turbine. Here, we're pumping water down hole under pressure. When you let the pressure off, water comes shooting back up out of the hole, turns a turbine. It's like a big land battery where the earth gives you everything very cheaply. It sounds kind of like a crazy idea, and no one was willing to pay for the pilot test because you could have squandered $1 million in a couple of hours. And so we syndicated 4 philanthropists around this opportunity, went out and ran one pilot test, crushed the technical milestones, were able to raise a seed 2, which was 50% charitable, 50% commercial investors, ran 47 more tests in partnership with a large oil and gas company in West Texas, went very well, raised a seed 3, which was 80% commercial, 20% charitable, recruited a CEO, and then was able to raise a Series A, which was 100% commercial capital, $7.6 million, co-led by the Breakthrough Energy Ventures and Evoke Innovations. And so that model of catalyzing and crowding in commercial investors is exactly what we need to do, not only at the earliest stage, but then this company, the next commercial pilot they're building was bid in by the state-of-the-art battery company for $9 million. They're building it for $1.8 million. So that is the type of cost improvement that we need to do like all of the rest of the value chain, and it's cost reduction, because I, for one, personally I hope with all of my heart that it happens, but a global price on carbon, we had, during the Obama administration, we had the White House, the House, and the Senate, and we did not have the political will to make this a priority. So short of that, we need to fill these financing gaps.
Good. So we're almost out of time, but I quickly want to go to Jennifer and Zach. And Jennifer, you guys are involved with benchmarking, and we've talked earlier about some of the challenges in actually getting to real benchmarks around some of the things we're doing, and you're doing something specific with IRIS, which is part of the whole GIN network. Can you tell us a bit about that?
Sure, and I can tell you a little bit about it, but I will also say that we want to be responsive, and what we want to do is make sure that investors who are looking for an impact look at what we're doing and get the data that they want and that they need out of our investment strategy. And so we had looked at a gears rating as something that investors had talked about as being useful to them. But as Joyce said, every company we invest in is doing a few things. They're reducing CO2 emissions by the work that they're doing. They're creating jobs because we invest in things that are at the construction stage, and so there's construction jobs, and then there's ongoing operations and maintenance. So there's sort of economic activity, and there's environmental improvement and CO2 reduction. So that's 100% of what we do. And the question is, what do investors want to know about that, and what are your goals? Because we can deliver that, and we can deliver that however, our companies are excited to report this information. they're open books to us, and so the question is, what is helpful to you? And so we're doing a lot in trying to capture jobs data, not just construction jobs, but also O&M jobs, and sort of more, a deeper dive in the employment statistics, because I think that's helpful. And also the CO2 reductions are easy to calculate. They just sort of come out of the project metrics. So those are the primary goals, but we really want to be responsive, and so we love for investors to tell us what's helpful, and we can deliver that.
Great. And Zach, lastly, you and I chatted briefly this morning about this notion that words have meaning, and the term climate change is sort of this loaded concept in various parts of the country. And so if you ask a fisherman how you feel about climate change, the answer might depend on, what cable news network they watch at night. But if you ask about acidification of oceans, everybody's in agreement. So with your work in particular, and given the parts of the country you operate in, is that something that you have to think about in terms of how you frame the work that you're doing?
Yeah, and it's not just what part of the country, it's also what stakeholder groups. So a typical project that we'll have a federal land manager, a state agency from natural resource agency perhaps, you'll have a utility manager, and then you'll have investors. And one thing you realize really quickly is that nobody speaks the same language in these groups at all, and finding that common language is a huge part of the challenge. But I'll relate a story too that I think is very relevant to this. When we started our company, Obama was the president. He had just started the Natural Resource Investment Center, which was really a way to kickstart natural infrastructure investment. This was in 2015. And then we had that election and everything changed. And actually the best advice I got was from our partnership coordinator at the Forest Service. She said, I come from the coastal South. Where I live, it's very conservative. People don't talk about climate change. They say the ocean is getting closer. and I took that, I was like, okay, so how you say something is really important, because if you talked about climate change, they get defensive. So our takeaway from that is, as we engage with the administration, which we have to do in this job because we work with federal partners, we use terms like public-private partnership, private investment, rural job creation, and the areas in California where I spend most of my time are deep, dark red Trump country. People don't think that exists in California. I'll be honest with you, it does. It is 100% real, and if that's what the president and the administration care about, how those voters, let's tell them the story about how we're actually helping some of those voters. And the last piece of this that I think is important is how you communicate with investors. We're launching our first pilot project to actually close next week, and we have a mix of concessionary investors or charitable investors doing program-related investments, and we also have market rate capital. And what those foundations want to see in terms of an impact report and how we're explaining the impact that's achieved by each one of these projects is very different from our commercial investors that are insurance companies that want to see the fire risk reduced, and they don't really care how that's quantified, and they don't necessarily care about the tons of carbon emissions avoided from this or the water outcomes, but actually in our structure, utilities are going to make payments based on some of those water outcomes. So how we communicate each one of these outcomes to different stakeholders is really a challenge, and we've got to sort of push everybody towards speaking the same language and facilitating those conversations.
Great. So we are out of time. We've been out of time for some time, according to the nasty looks I've been getting from David. So thank you all very much, and thank you, audience, and Margot, you and your team as well.